Hello and welcome to this session. In this session, we will learn about IPOs, Clause 49, Red Herring Prospectus, book building process, and book running lead managers. Let us begin with IPOs. An initial public offering or IPO is when shares of an unlisted company are sold to the general public for the first time. The private company offers its shares to the general public and thereby becomes a public company. An IPO is also called a stock market launch. It is a process where a private company converts into a public company. Hence the term going public. Companies go public with the goal of raising capital. The IPO process provides quick and large amounts of capital funds for various business needs such as expansion, diversification, or even capitalization. Capital thus obtained can be used to fund research and development, fund capital expenditure, or pay off existing debt. So, why do companies go public? When the company lists its securities on a stock exchange, the money paid by the investing public for the newly issued shares goes directly to the company. This method provides capital for various corporate purposes through the issuance of equity without incurring any debt. Another advantage is an increased public awareness of the company because IPOs often generate publicity by making their products known to a new group of potential customers. This ability to quickly raise potentially large amounts of capital from the marketplace is a key reason many companies seek to go public. Technically, the process of an IPO is lengthy, complex, and involves a lot of legalities. However, in a snapshot, it first considers the eligibility of the company. Then, one needs to appoint various agencies for the IPO process. Next, you have the registration of all the required legal documents. Then, one needs to determine the price at which the new issue has to be done. And finally, the shares are allocated to the investors. Companies willing to issue an IPO have to meet certain criteria before getting an approval from the governing body. Company should have net tangible assets of 3 crore rupees in each of the preceding 3 years. It should earn distributable profits for at least 3 out of 5 preceding years. The company should have a net worth of 1 crore rupees in the preceding 3 years. Finally, the proposed issue should not exceed 5 times of its pre-issue. Next, we come to Clause 49. Clause 49 of the listing agreement to the Indian Stock Exchange came into effect from 31st December 2005. It has been formulated for the improvement of corporate governance in all listed companies. Broadly, Clause 49 outlines the norms to be followed by the companies in order to get listed. It details the expectations which needs to be fulfilled before going public. Clause 49 encompasses Board of Directors, Audit Committee, Remuneration of Directors, Board Procedure, Management, Shareholders, Report on Corporate Governance and Compliance. Now coming to Board of Directors. Starting with the composition of the Board of Directors, there can be executive and non-executive directors. At any point in time, non-executive directors should not be less than 50%. If there is a non-executive chairman, at least 1/3 number of independent directors should be there as well. When there is an executive chairman, then at least half of the board should comprise of the independent directors. An independent director should be a non-executive director. The audit committee should be financially literate, and at least one of the member of the committee should have accounting or financial management experience. The audit committee's tasks include review annual as well as quarterly financial statements with the management before submitting the same to Board of Directors. Review companies' financial and risk management policies and look into reasons for defaults, if any, in any kind of payments. Mandatory reviews include financial statement, audit report, MDA, and results of operation, legal compliance, and risk management. Finally, their role also includes observing statutory and internal auditors. These are only a few of the important functions performed by the audit committee. The actual list goes on. Coming to the red herring prospectus. It is also known as the first or preliminary prospectus, which is submitted by a company as a part of IPO process. A red herring prospectus is issued to potential investors. Potential investors may not place buy orders for the security based solely on the information contained within the preliminary prospectus. Instead, they express an interest in the offering, provided that they have received a copy of the red herring at least 48 hours prior to the public sale. Once the registration statement becomes effective, a final prospectus that contains the final IPO price and issue size is distributed. Expressions of interest are then converted to orders for the issue at the buyer's option. Why is it called red herring prospectus? It is a legal disclosure printed in red, informing the readers that the same has not been approved by the governing bodies. Securities may not be sold or offers to buy be accepted prior to the time the registration statement becomes effective. The red herring statement contains the purpose of the issue, That is, the red herring prospectus RHP needs to clearly state the purpose of the IPO listing along with the avenues in which the new capital will be utilized. The disclosure of any option agreement is in case the company has got into any option agreements. The RHP needs to clearly state this so that the investors are not misled at any stage. The underwriter's commission and discounts. The red herring prospectus needs to expressly mention the amount of fees, discounts, and any other considerations that are provided to merchant banks for underwriting the IPO. Promotion expense. The red herring prospectus needs to expressly mention the amount of fees, discounts, and any other considerations that are provided to merchant banks for underwriting the IPO. The red herring statement also contains the net proceeds to the issuing company, that is the issuer, the balance sheet, the earnings statement for the last 3 years if available, and the names and addresses of all officers, directors, underwriters, and stockholders owning 10% or more of the current outstanding stock. And the list goes on. Now let us talk about the book building process. The process by which an underwriter attempts to determine at what price to offer an IPO based on demand from institutional investors. In simple words, book building is a method of marketing the shares of a company, whereby the quantum and the price of the securities to be issued will be decided based on the bids received from prospective institutional investors. During the IPO, the company offers its shares to the public either at a fixed price or offers a price range so that the investors can decide on the right price. The method of offering shares at a price range is called book building. The issuer nominates a lead manager who acts as a book runner. The issuer also specifies the number of securities to be issued and the price range. The book should remain open for a minimum of 5 days. Bids cannot be entered for less than the floor price. The book runner and the issuer conclude the price at which it is willing to issue the stock and accordingly allocate the securities. This issue size gets frozen based on the price per share discovered through the book building process. Finally, allocation is made to the successful bidders. Now that you know what book building is, let us now review the book building process. First, the company plans an IPO via the book building process. Then, a merchant banker is appointed as the lead manager. The lead manager then issues a draft prospectus and files it with SEBI. Next, the lead manager syndicates members and registered intermediaries. Next, you have price discovery through the bidding process. And finally, The book runner and the company decide the allocation and allotment. A merchant banker possessing a valid SEBI registration is eligible to act as a book running lead manager. In the pre-issue process, book running lead managers, also known as BRLMs, take up the due diligence of the company's management, business plans, and other legal formalities. Other duties include drafting and design of offer documents, prospectus, statutory advertisements, and memorandums. BRLMs ensure compliance with stipulated requirements and completion of prescribed formalities with stock exchanges, registrars, and SEBI. They also play a role in the finalization of the prospectus, appointment of other intermediaries like advertising agencies, bankers, printers, etc. Post-issue activities include management of escrow account, coordinate non-institutional allocation, intimation of allocation, and dispatch of refunds to bidders, etc. More than one book runner can manage a security issuance, in which case the involved parties are called joint book runners. Now let us take a look at the leading book running lead managers in India. These include Axis Bank, ICICI Bank, Standard Chartered Bank, Deutsche Bank, Yes Bank, HSBC Bank, and Barclays. Moving on to Dutch auctions. A Dutch auction is a method for pricing shares in IPO whereby the price of the shares offered is lowered until there are enough bids to sell all shares. All the shares are then sold at that price. During bidding, investors indicate how many shares they're willing to buy and the price they're willing to pay. The underwriter, who acts as the auctioneer, usually starts the auction by offering a prohibitively high price for the security. It then lowers the price gradually. The first bid made is a winning bid and results in a sale assuming that the price is above the reserve price. The goal of a Dutch auction is to find the optimal price at which to sell a security, and that too quickly. Underwriting is a good technique for marketing the securities. It ensures adequate finance. It benefits from expert advice. It ensures increased goodwill. It ensures geographical dispersion of securities. It is a service to prospective investors. It is a service to prospective investors. Underwriters provide several services, which includes correctly assessing the value of shares and establishing a public market for shares. Alternative methods such as Dutch auction method are also provided. In a firm commitment offering, the underwriters will purchase the shares at a discount. usually at 7%, and resell them for the full public offering price to institutional and individual investors. The biggest underwriters are Goldman Sachs, Credit Suisse First Boston, and Morgan Stanley. Finally, let us talk about the other players in an IPO, namely lawyers, printers, auditors, and bankers. Beginning with lawyers, they help in deciding what kind of securities the business can sell in an IPO. They ensure that all the financial statements are true and apt as per company's law or any other prevailing guidelines. Even while drafting the prospectus, lawyers ensure that all the clauses are included and conditions mentioned. They ensure that at all stages, pre-issue or post-issue, the company is a law-abiding firm. Also, it ensures that the company doesn't end up getting sued over legalities. The company and the underwriters will each be represented by legal counsel. Internally, company counsel will review the company documents, records, and business to identify potential legal problems and make required disclosures on the prospectus. Company counsel will also coordinate the drafting of the registration statement, guiding it through the SEC review process, help negotiate the underwriting agreement, and coordinate with the other participants. Externally, legal counsel for the underwriters will represent them in the registration statement, drafting, and due diligence process, as well as in the preparation of the underwriting agreement. They will also coordinate document reviews with the National Association of Securities Dealers or NASD and any state securities authorities. The best example of lawyers being involved in IPO is Facebook IPO. Fenwick and West LLP and Simpson Thacher and Bartlett LLP were the appointed lawyers for this IPO. Next, we come to the role of printers in the IPO process. The printer will print the prospectus. The transfer agent will issue and transfer the company's shares and coordinate shareholder mailings. And the banknote company will design and print the new stock certificates. They also print the annual, quarterly financial statements which have to be submitted with SEBI or SEC. As strategic and technical advisors, a company's independent auditors will play a key role throughout the registration process. At the start of the IPO process, a company will need to ensure that it has selected an audit firm that is registered with the Public Company Accounting Oversight Board. The audit firm needs to have expertise in generally accepted accounting principles. They offer strategic advice in the planning stage of the process to establish a realistic plan to enter the capital markets. They also provide guidance on the identification of potentially sensitive or problematic accounting issues, financial disclosure issues, and the overall transparency of financial reporting. They also are responsible for audit of the financial statements. They assist the underwriter in his due diligence efforts. Banks are responsible to collect and deposit the money collected from issuance and transfer the same to the issuing company. Once the shares have been allocated, the same account is refunded and the remaining subscribers are paid back in a timely manner. Bankers carry out all the activities of ensuring that the funds are collected and transferred to the escrow accounts. These banks also act as lead managers and consultants in certain cases. Post-issuance, banks maintain the company accounts for timely payments of interest and dividend. Stock split or bonus and rights issue are also handled in a similar manner. Finally, let us look at some IPOs in India. The Reliance Power IPO was one of the most successful IPO in the history of Indian market. On 15th January 2008, the Reliance IPO fetched $27.5 billion of bids. The upper cutoff price for the bid was 450 rupees. Reliance Power Limited was planning to generate capital worth 11,700 crore rupees through this IPO. The size was approximately 26 crores equity shares and the price band was 405 rupees to 450 rupees. Lead managers were Kotak, UBS Bank, Enam, ISEC, among others. Though the Reliance Power IPO witnessed huge investor interest and was fully subscribed within first few minutes of its book building process, it could not sustain the momentum in listing and dipped below its issue price. This chart shows how much capital was raised in 10 largest initial public offerings in the United States. The Facebook IPO was the most talked about IPO in the recent times. But in terms of the capital raise, Alibaba takes the cake. In the initial public offering of Alibaba Group Holding, a Chinese company operating in the e-commerce sector, on the New York Stock Exchange in September 2014, was the largest listing in the United States since 1996. The IPO of Alibaba Group Holding raised approximately $21.77 billion. The IPO of Alibaba Group Holding raised approximately $21.77 billion. We have now reached the end of the session. Thank you for your time.